investing.
Welcome back. You're still with us on Markets Today. Let's get to the rest of the stories that we're tracking for you. The fourth headline today, market regulator SEBI has sought updated details of foreign portfolio investors from bank units for greater clarity on registration and beneficial ownership. Prashant is standing by with the details. Prashant.
Well, thanks very much for that. Now, what we understand from industry sources is that SEBI has written an email to banks who deal with FPI registration as a process. This email was sent out last Friday evening with a focus basically on two issues. One is FPI registration and the second is beneficial ownership. Let me explain this a bit. So what is SEBI saying? SEBI is asking what are called designated depository participants to reach out to their foreign portfolio investors by the 31st of March 2023. Designated depository participants, DDPs, by the way, are units within banks who deal with a specific function of FPI registration. So SEBI is asking these entities, DDPs, to in turn ask their FPIs who are registered with them to give them the updated beneficial owner details by the 30th of September this year. So there are very clear timelines here from the regulator. The SEBI communication says that if this is not done by the 30th of September, these FPIs would then become ineligible to continue their registration, which would then, according to the email, mean that they will have to sell their holdings, liquidate their holdings by the 31st of March 2024. I mean, I would like to add here that we've written to SEBI for an official comment and we are awaiting a response from them. Now, to explain this issue with some examples, right? As I said, SEBI is focusing on two things. Number one is registration of FPIs. If I can sort of use an example, if there is, for example, a German bank which is a unit based out of Hong Kong or Singapore or anywhere else which invests as an FPI in Indian markets, SEBI is saying that the legal entity in this particular example, in this particular case, is the German bank, right? And not the unit operating out of Hong Kong or Singapore. Number two, the second issue the SEBI's communication touches upon is identification of beneficial ownership. So if there is a FPI investing in India, and there is no entity which can be clearly identified as the owner, the threshold for to be considered an owner is having 10% or more invested in a fund, or control. If these two criteria are not met and a natural kind of owner or controller cannot be identified, then the beneficial owner has to be identified as a very senior person and not a junior person or someone managing money, etc. It has to be at a managing partner kind of level. All in all, clear communication from SEBI that it wants to know the end beneficial owner of FPIs, and there are clear timelines given by which it wants this information as well. As I said, we've written to SEBI and are awaiting a response from them. Back to you.
Okay, all right, Prashant. Thanks very much for that important story there. But let's move on to the fifth story today. Paytm rallies close to 6% in trade as the company turns profitable at the EBITDA level for the first time ever, ahead of its forecast. Abhishek is here with the details.
For Paytm, the contribution margin increased to 50.8% versus a little more than 44% in the previous quarter. So what this helped is that it helped the company report a first-time EBITDA being positive at about 30 odd crores. So they reported EBITDA of about 31 crores, which compares to EBITDA loss of 393 crores on a YOY basis and about 166 crore loss on EBITDA front on a sequential basis. The total income was up more than 39.5% YOY and about 6.3% sequentially. Their net loss has actually declined to 392 crores, which compares to an estimate that ICICI Sec had of about 500 crores, and this also compares to more than 775 crore of net loss in the same quarter last year and about 572 crore of net loss that they reported in the previous quarter. Back to you.
Okay, all right, Abhishek, thanks very much for that. Well, it was a strong quarter for M&M Financial as well, with the assets under management rising 16% and the gross NPA ratio at a 15-quarter low. The stock zoomed 7% on the news. Here's what the management had to say on its assets under management.
We are seeing quarter-on-quarter growth in AUM clearly, and that's at the back of very, very healthy disbursement that's happening, and I think it will continue to move this direction. And we are currently growing at about 20-odd%, and I think we would kind of keep this direction. In next 2 or 3 quarters, maybe post-festival, you would start seeing the interest rates come down. So we don't see any pressure on the NIMs to the extent that we need to cover, we already done. So I think fairly around this NIMs, maybe a 20 basis point here or there could happen. And that could happen maybe also because of the product mix change and not necessarily because of the borrowing cost pressure.
Okay, so that's M&M Finance. But moving on, beverage bottler Varun Beverages surged over 6% or 5% in trade as the company reported what was a strong performance in what is a seasonally weak quarter. Manglam is here with the details.
It's a seasonally weak quarter for a company that makes cold drinks because of winter, but it is this delayed winter festive season and a low base because it was also the first festive season after 2 years of COVID-related impact that boosted their performance. A strong quarter coming in, 28% jump in their overall revenues, closer to 2,200 odd crores on the top line. The gross margins improved as well, and as a result of which we saw a big improvement in their EBITDA too. And that was primarily because of operating leverage coming in. The margins for the company 13.9% versus 12%, and the net profit jumped by around 150 odd percent on a low base. Again, the net profit was led not only by the revenue and the EBITDA, but a couple of other factors like lower effective tax rate and higher other income boosted the net profit as well. The overall volume growth of the company this time around was 18%, but at the same time, 70% of their revenues coming from carbonated beverages. That saw a 25% volume growth. That was extremely strong. Juices grew by about 17%, whereas water grew by just around 5 odd percent. Sting, which is the energy drink, which does well for them in terms of realizations and margins, is now about 10% of sales, and most on the street are betting for higher contribution coming in from this to improve their performance going further. And as a result of which, their net realization increased by 6% as well. That's just the beverage part of the business. They do have a big trigger coming in from the snacks part as well. So let's see how that plays out. But for now, in a seasonally weak quarter, Varun Beverages actually reported a very strong set.
Thanks, Manglam, for that. But now let's put the focus on Divi's Lab. The stock has slipped over 15% in trade on Friday after posting a disappointing set of Q3 earnings. It was down around 12% on Friday's trading session and has seen an incremental loss today. Divi's Lab's margins were the key disappointment in Q3. The company, which was once lauded for its margins sustaining at over 40%, reported margins at a historical low of 23.9%, led by factors such as cost inflation and pricing pressure. This quarter also saw the impact of COVID-19 opportunities such as molnupiravir depleting. Estimates are Divi's only made as low as $5 million of sales from molnupiravir versus $130 million a year ago and $40 million just last quarter. And besides COVID-19 opportunities depleting, the company was also impacted by the underlying profitability in the generic API business, impacted due to price pressure in the US markets. Some products faced anywhere between 5 to 10% price erosion. Brokerages were clearly disappointed with this quarter, with target prices reduced and EPS estimates cut anywhere from over 10% for FY23 to over 15% going into FY25. The street fears earnings to be impacted more than earlier due to a high base in the custom synthesis segment, price pressure in the US and an overall reset in margin expectations. Lastly, what could help turn the stock around? A few triggers include the Kakinada capex for the company coming on stream, for which the company got a green signal to resume construction, recovery in margins, price pressure in the US settling, and opportunities coming through in other segments such as contrast media and fast-track projects. And valuations, once the darling of investors, the stock has already lost over 40% from its 52-week high and is now trading at over 35 times FY24 PE, which is a far cry from the peak of over 70 times, but still expensive, according to some. Well, on that note, it's a wrap on this edition of Markets Today. Thank you very much for watching.